Well, retail sales figures out just a short while ago show a contraction of 1.7% year-on-year in January from a revised contraction of 3.8% in December. The number is a little bit better than consensus forecast of a 2.5% contraction. Joining me for more is Tendani Mantshimuli, economist at Liberty Life. Tendani, thanks for coming to the studio.
Hi, Stephen.
And Tendani, a little bit better than expected, and January, I should imagine, is a pretty bad month for retail sales because nobody has any money left after Christmas.
That was a surprise, actually, because we expected around 2.5%, and to come out at minus 1.7 is really good. I don't think we can point out to one factor that influenced it, except to say that people are beginning to believe that the economic recovery is going to take hold. We've seen 2 quarters of positive growth, and that is showing through to the consumers, because you cannot say there's been a material change in the disposable income yet.
Of course, we do know that car sales figures out recently showed quite a nice pickup in December and then again in January, particularly in January, with people waiting for the new year before they registered a new car. So do you think that auto sales could have given perhaps these numbers a boost?
Yeah, I think so. The car sales story was also a surprise on the upside because they did much better than we expected, considering that people are not really borrowing and they're not really out there to buy durable goods. So consumers are starting to become more confident about their own financial positions, about the financial position of the economy. So they're starting to invest in long-term items, particularly durable goods, as you mentioned, cars earlier.
Of course, we did have those consumer confidence numbers out from the Bureau for Economic Research yesterday, also showing a nice uptick in the first quarter of this year from the last quarter of last year, moving from 6 up to 15.
Yes.
So as you say, that's really backs up the fact that we are starting to gain a bit more confidence. And of course, we had all those interest rate cuts last year.
Yeah, we had the interest rate cuts, so we currently have a low interest rate environment, low inflation, which we expect is going to continue through. Although I don't believe with the numbers that came out today, the GDP numbers that came out a couple of weeks ago, the car sales, there's any chance of an interest rate cut. So consumers would have to be content with what we have now. And the other thing that is important is predictability. You know that interest rates are likely to remain unchanged for a while. So you feel more confident in trying to make those purchases, particularly those that are of a durable nature, like the car sales, as we've mentioned earlier. I do believe, however, as well, that consumers are starting to think that the job situation is going to be stabilizing. We're not going to see any new jobs created, certainly not at the scale that we've seen in 2006, 2007. And we know that we don't have a history of creating many jobs, even though the economy is doing well. But having said that, I do believe that we're not going to see many job losses at the scale that we've seen in 2009. And in the PMI numbers that came out, the indication is that in the manufacturing sector, at least, we are over the 50 index point, which means that not many job losses expected there. So that is good for consumer spending.
Of course, we know consumption has been one of the weak points in the economy over the past year. We're not likely to see a rebound, are we? Do you think it's more likely to be a gradual uptick?
I'm looking for a gradual uptick, consistent growth, certainly not the rebound that we've seen in the numbers that we saw 2006, 2007. We'll have a better indication when the bank releases the quarterly bulletin next week. But I don't expect to see on the consumption side that we're going to see a large positive number. If we do see a positive number, it will be a small one. However, as the year progresses, particularly when we come to the second quarter, when we have the World Cup, I do believe that retail sales are going to pick up even stronger. I don't foresee, however, that we're going to get back to pre-2008 levels just yet.
Of course, household debt's still quite high historically for South Africa, around 80% or just below 80%. And although that's favourable if you compare it to the United Kingdom or Australia or any of those developed countries' economies, it's still quite high for us. Do you think we need to bring that lower?
It should be coming down. The bank is also going to release that number. I'm expecting it to be around just over 70% for the fourth quarter. But however, what is encouraging is that people are not taking up more debt. Presumably, they are going to work down the debt that they have already. And throughout this year, I should expect that we should get back to below 70. And if people have worked down their debt to comfortable level, employment takes hold, and no job losses to the extent that we've seen last year, I expect that consumer confidence is going to pick up even more, and then you're going to see people starting to spend.
Do you think people aren't taking up more debt because banks aren't lending more money? Because we have reports in the papers kind of hinting that the banks might not be, particularly in the housing markets, are just not making enough credit available?
I think it's two-pronged. It's both the stringent lending conditions from the bank side as well as the NCA that is preventing them. But also, I do think consumers are more cautious of taking up more debts than we can afford to service. I mean, a lot of people bent their fingers last year. I don't think there are many more people who are going to go out there and take more debt simply because it's offered. If you haven't looked at your own financial position, if you haven't looked at what employment prospects are likely to be coming your way, or if you're going to keep your job for that matter.
Of course, just ahead of that Monetary Policy Committee decision next Thursday afternoon, we are getting the CPI and PPI numbers. They've been brought forward slightly to 9:30 or 9 o'clock rather than 11:30. What sort of numbers are you looking for? Are we still going to be outside of that target range? Do you think we'll be back in the top of that target range on
I should
consumer?
think we are going to be moving back to within target or just on 6% roundabout there. But I do believe that for the MPC on Thursday, there's no reason to cut interest rate. I should think they should leave interest rate unchanged. The numbers that have come out do not support any stance in monetary policy. Even with the expanded mandate, I don't think they should cut interest rate. The economy is picking along quite nicely without intervention from the central bank.
And of course, we do have a threat to inflation going forward. That's in the electricity price increases we're going to see coming through pretty soon. We also have the World Cup coming up in 2 months' time, and that's likely to be quite inflationary as well, although it will boost retail sales, I'm sure. Yeah,
it will boost retail sales, and definitely, as you mentioned earlier, the Eskom tariff hikes are going to put pressure on the consumer price index, particularly the electricity part. So we're going to see electricity prices pushing inflation higher, and for that reason, it's prudent for the bank to leave rates unchanged rather than cut now and then you have to hike rapidly and too much in the months to come.